Um, Good afternoon to all. Can you all hear me? Oh, and can you see the presentation as well?
Yes, sir, it's visible.
Yeah, Gavin, thank you. Uh, okay, I think you might have done our 5 classes previously on this financial system. It's a postgraduate executive diploma in bank management. Um, Actually, this should be the first 5 lectures, but I was unable to uh, conduct this discussion um, in the first half, right? So this is the second half. So Gavin, you all are continuing from the very first day, isn't it?
Yeah, most of them have been there from the very first day. I joined from the third class, actually.
All right, no issue. So actually, I just want to give some brief on the exam and the syllabus, and then I would like to continue the balance discussions. Uh, Basically, this is a financial system. It's a, I think, mandatory subject for this postgraduate executive diploma. If you take the exam, it's a 3 hours exams anyway. You can see like 6 questions in the papers. One is compulsory, that is given with 40 marks, and others 20 marks each. And I think the first one is the compulsory one, and from other balance questions we have to choose 3. So altogether you will get 100 marks. So first is 40, the mandatory questions, and then balance 3 questions, you'll get 20 each. So altogether 100. So this discussion, so I'll be having 5 areas under this discussion. Mostly I would be taking 3 hours class. This will go on to maybe 6 to 7 classes, because I don't want to like take continuously 4 hours virtual class. So I'm just a little bit suspicious of the effectiveness of those 4 hours in a single leg, taking discussing all these matters. So maybe a little bit sometimes complex. So, and I want to give some time to you all to read. So the basically the references you can use, there are two. There are several. That main two I have given here. One is the economics of money, banking, and financial markets. That's the Miskin books. So you can refer any editions. So this one is basically from 10th edition. And then second one, also very important one, money, banking, and financial markets. That's I mentioned, like second edition. It would be any editions. That's a Stephen and Brandeis, right? Brandeis University, right? So these are the references. Actually, like for you all, take a one book, right? Whichever, like understandable for your purview. Take that book, and anytime in your lifetime, right, you can take it any time and refer that. That should be kind of Bible for you, right? So rather than like jumping from book to book, so if you have a thorough knowledge in a single book, you can expand your knowledge based on those books. So these are few books I impressed, so I have given here. My discussion also mostly based on Miskin books. It's a lot of reported universities they used, actually. Even in my masters I used this one, so that's what I just brought here as well. So that's about the exams and references. And then in this financial system syllabus or key areas, there are 10 key areas, right? So 1 to 10 you can see. The first 5 I would be discussing. The next 5 I think you have already discussed. Is there any pending out of next 5? Just if there's anything, just let me know. The first one, money and the financial system. And second, interest rate, financial instruments, and financial markets. It's basically overall interest rate analysis. And third, financial institutions. Fourth, central banking and conduct of monetary policy. And fifth, international finance and monetary policy. So about me, I'm working at Central Bank of Sri Lanka. You can call me Sean. That's of course okay for me. So these are the 5 areas I would be discussing with you all. It's all discussions. And other 5 already I think you all have discussed in the previous classes: derivative instruments, the properties and pricing of financial assets, financial markets, portfolio theory and pricing risk, mergers and acquisition. So I think you might have done already. I could see the names here. Of course, all are following with me, or is that okay? Anuradha, is that fine?
Yes, sir. Good evening, sir.
Yeah, good evening. At any moment you can raise your hands, or like you can interrupt me and discuss, because I wanted to have this one as a, like, virtual even discussion forum, not like theories and just not as high school one. So I'm giving theories and you learn and write the exams. We will have some kind of practical approach, right? So but still we have to cover our syllabus as well. So we will have a flow, and within that flow we will discuss theory plus practice, right? Okay, so these are the 5 areas. Sometimes you may feel some areas overlapping, but even though that is overlapping, it's based on different perspective, right? So you should understand that first, right? So maybe easy, if you have already done some calculation, that might be easy for you to understand my perspective, right? But maybe you sometimes you can feel on that, because interest rate is, that's a backbone of these discussions. Okay, so today's lecture, or discussion rather, would be on money and the financial system, right? You all can see the screen, right? Isn't it? Presentation, and it's already uploaded, isn't it?
Yes, sir.
Thanks. So under this money and the financial system, the first lecture, so we would be discussing circular flow of economic system, measuring national income, and then an overview of the financial system, the 6 parts of financial system: money, evolution of payment system, and measuring money, right? This would be the first class discussions, and if time permits, we can discuss a little bit on the second lecture part as well. This is introductory but covering overall aspect. This part is very important. This is why I'm saying that this is give you a way to have kind of mind mapping, right? If you can map in your mind perfectly, this is the financial system, and the rest is very easy. Just plug other information into that mapping, right? So you, wherever you go, right, start from here, right? So whatever the discussions, whatever the informations, whatever the technicalities, you just connect to this, then you never forget. And when you answer your questions, or when you have discussion in your office, you clearly articulate your argument based on the practical scenario of this. That's what I always start any subjects based on this. So here also, even though it's a financial system, I'm going to start with economic system, right? You can see in the screen the circular flow of economic system. We might have done this one in our high school, maybe even basic degree, right? So this is basically how an economic system works, right? Okay, in an economic system, right? There's a problem. What is the problem? Anybody? Chaminda, you always have a problem in an economy. You try to solve in an effective manner. What's that?
Financial stability.
Not really. Anybody else? Chaminda, you can try.
Scarcity?
Yes, scarcity. When you say scarcity, what's that all about?
Lack of resources to have the output. I mean that there is no overflow of resources. You have to allocate them separately and effectively.
Yeah, Anuradha, you are almost there. Yes. Now, when you see in an economic system, always we have a problem like you have, like in the sense, you have unlimited needs and wants. People have unlimited needs and wants, right? But you have only limited resources. This is the base of any economic system, right? When you have limited resources and unlimited needs and wants, how we are going to satisfy those unlimited needs and wants with these limited resources? This is the problem always, right? So in a basic economic system, the function of a basic economic system is to allocate those scarce resources to produce goods and services which is needed by the society, right? This is the basic problem, right? Because we have the scarcity of resources, you always have some economic questions, basic economic questions. What to produce, where to produce, how much to produce. These questions are because of the scarcity. If we have unlimited resources, you don't need to worry about that. You just produce whatever you want, whatever you need, right? So the problem is you have limited resources. So the basic function of the economic system is to allocate scarce resources. When I say scarce resources, what does that mean? So we might have learned, like, production factors. You want to have an output, that means goods and services. To produce them, you need production factors. Those are the scarce, limited in availability. That can be land, that can be labor, or management skills, or capital. Right? So these are the production factors we might have learned in our A levels, right? So those production factors are scarce. Using those production factors, we are going to produce goods and services. How we are going to allocate those to get the maximum output? So it's evolving, right? So that is the basic function of an economic system, right? Okay. Now, if you see this circular flow of economic activities, you could see in a basic economic system, how many agents are there? In a basic, very basic one, or you can call it closed economy. Economic agent, Gavin?
And the consumer?
Yeah, okay. We call it household, right? Consumers, right? Households. The other one? Firms, right? So basically two players are there in a basic economic system. One is household, other one is firms, right? So here we assume that all production factors are belongs to households, right? So households, they have land, they have labor, they have management skills or entrepreneurship or capital. The households holds those production factors. Firms are there to produce, so they get these production factors from households. You can see bottom in this circular flow of economic activities. You could see in the bottom of this picture, the arrow goes from household to firms. That is the in orange color, that's factor of production, labor capital, land, and entrepreneurship. Right? So households provide those production factors to firms. In return, firms give back income. You're following me, right? It's not a very complex things. So, Anuradha, is that okay?
Yes, sir.
Yeah. So then the households provides factors of production, that's labor, capital, lands, and entrepreneurship. So firms using those production factors produce goods and services, but in return, they pay income to the households. That means they pay wages, interest, so wages for labor, interest for capital, and rent for land, and profit for entrepreneurship. So it's like flowing into household as income. Other hand, what will happen when the firms produce goods and services? They sell to household. You can see the upper side of this picture, the goods and services moving towards households from firms. Then in return, household, they spend on these goods and services. That becomes revenue for firms. You can see green color. This is a circular flow of economic activity in a basic economic activity. It's, as I said, it's a closed system. I didn't bring import, export into this. Or in advance, I didn't bring government into this. It's a simple economic system. You could see the economic activities in a circular flow. Here you could see two kinds of markets. If you see the bottom part, it's a resource market, or we can say factor market, because labor market, right? Land, everything going through that flow. So it's a we can say a resource market or factor market. But if you see this upper part of this picture, it's a goods and services market, product market. So now you are clear, there are basically there are two markets in a basic economic system, goods and services market and factor markets, right? But if you see this circular flow of economic activities, you could see this green line, green arrows. What are those flows? Anybody? Now, what is the difference between this orange arrows and green arrows? Anybody? Chaminder? two different flows you could see. What are those, Gavin?
The inflow of the income and something like the outflow, like the orange is the outflow, the expenses or
Yeah,
what
you are
whatever
very
you
close.
provide.
Uh, um, yeah, just we can change slightly. If you see this green arrow, it's a finance flow, right? And orange, it's a real flow, right? So goods and services or factors of production, it's a real economy flows. The green you could see is financial flow. In an economic system, if that is should be like, if that economic system should flow properly, continuously, or effectively, you should have like equal or simultaneous financial flow into that. As I mentioned in the slide, the global economy generates a flow of production in return for a flow of payments, right? The payment flow is always there that stimulate real economic activities. So this production flow and this finance or payment flow, it's never ending, always, flow in the opposite direction. So now you know how important a financial flow to make this economic system work. Is that clear? To make this economic system work, you need a proper, efficient financial flow. Right? Make it clear. Now you know why a financial system is very important. Without a financial system, you won't have an efficient economic system because it's interdependent. If you see in the next slide, right, I'm just giving an idea of a country, what's happening in the economic system. Here you could see, okay, if you take this as a country, household provides factors of production. Using those, firms produce goods and services. Now, this value of factors of production and the goods and services produced by the firms are equal because that includes wages, interest, rent, and profit as well. When you produce, you spend for your inputs, and then finally entrepreneurship, that also coming from the households. So the margin is profits. So all inclusive. So then the value of the product and service is equal to the payment you made to the production factors. Is that clear? And similarly, the next step, the goods and services produced by the firms is bought by households. They got already income from the firms by way of wages, interest, rent, and profit. And then they spend on goods and services using those income. Now here, the value of the goods and services is equal to the household's expenditure. If you take together, the income of household is equal to the production of goods and services, and that is equal to the expenditure of household. Is that okay? You got that point? Anybody? Anyway, so Anuradha, you got it? I couldn't see others' name anyway.
Yes, fine.
Okay, so now you could see, if you take a country as a whole, take it Sri Lanka. If you take Sri Lanka as a whole, the Sri Lanka as a whole produce goods and services, right? So how much? That's the question. If you take Sri Lanka in this picture, circular flow of economic activity, this is Sri Lanka. You have two agents, households and firms. You produce goods and services. Now, at the end of the year, you ask how much you produce as a Sri Lanka. What is the technical name we can give it to that? Anybody?
GDP.
Exactly. Yes, Chaminda. We can call GDP. I don't want to go into details. That's a GDP. So in this slides, the second one, so that is we can call it national income, right? Sri Lankan, right? The production of goods and services as a whole. Now, first one, this can be measured in three ways. The GDP can be measured in three ways. One is aggregate output. Now you know the goods and services are produced by firms. The value of the goods and services produced by firms are the aggregate output. We call it aggregate. The word is very important. If I produce one loaf of bread, that is my production, my output. If you take all Sri Lankan people and take their output together, that's aggregate. So aggregate output we denote by Y. So this is the value of total production of a firm. The most commonly reported measures of aggregate output, the gross domestic product, GDP, as I mentioned in the slide, is the market value of all final goods and services produced in a country during the course of the year, right? If you take the year, during the course of the year, how much you have produced, what's the value of the market value of those goods and goods and services produced. So that is we call aggregate output. Now in the previous slides, you take this circular flow of economic activities. These firms produce goods and services. The market value of the total goods and services produced during the year is the GDP. This is aggregate output approach, right? In central bank, when we calculate GDP, if you go through the annual report, very important, that's a kind of snapshot of the overall economy's performance. If you take the annual report, you could see, right, GDP calculated based on the production approach. Just go through, right? So where we have given, okay, this much the GDP for 2029 or 2019, right, or 2020, you could see. That's one way of calculating, measuring national income. The second one is aggregate income. Now you can see in this circular flow, okay, this household provide factors of production to the firms, and households get the income, which are wages, interest, rent, and profit. That is aggregate income. As I said earlier, this aggregate income would be equal to aggregate output produced by the firms. So there can be another approach to calculate GDP. That is income approach. You could see we will call it aggregate income. Aggregate income, the total income of factors of production, land, labor, and capital, and profit as well. Entrepreneurship from producing goods and services in the economy during the course of the year. Right? Now you know the national income can be measured through aggregate output approach or aggregate income approach. And the third one, it's an aggregate expenditure. Now you could see the previous slides. Firms produce goods and services. Who is going to buy all goods and services? Who is going to buy? And rather, who is going to buy?
By households.
Households. They are going to buy entire output. Right? That's the basic assumptions. Right? Don't get into confusion. Right? There are assumptions behind this. Right? It's a basic system. So household, they are going to spend their whole income, right, to buy goods and services. So that expenditure is equal to the value of goods and services. So then the third approach also we can use, that is aggregate expenditure. Through that also we can measure the national income, GDP. When you say aggregate expenditure, there are key items to be incorporated into that calculation. If you take households, they can do expenditure on consumption. That's C. That is households. They can do investments. That's I. That also expenditure. And into this formula, I have taken government also, because in addition to the households expenditure or consumption, government also consumes, right? That is G, right? And I have taken here kind of open economy formula where you export and as well as import as well, right? You earn from export and spend on imports. So you add export and then deduct import. So it's an open economy formula I have given here, but that's a basic formula including all relevant factors. So I have put it here. So in that way also you can measure GDP. So whatever said and done, you can measure the GDP based on 3 approaches, but all the final output, that means the final value of the GDP in all 3 approaches is same. Aggregate output is equal to aggregate income and aggregate expenditure, because the payments of the final goods and services must eventually flow back to the owners of the factors of production as the income, and then income payments must equal to the value of the final goods and services. So here what I want to say is, right, you can see this one, how this economic system works, and whatever the ways you calculate your total production, that is equal, that is same. So this should be in your mind every time when we discuss, right, how this economic system works and what are the ways we can calculate the national production or national income or national expenditure. Everything is in aggregate basis when I say national. Clear? So this is the economic system works with basic activities, right? Now let's assume, right, this households not spending everything on the goods and services, right? So now here, if you take, they have to have some kind of savings because they are going to, right, invest on firms. That's what the production factors capital. Not only making payment for goods and services based on your income, but also you are going to make some investment on firms as a capital. How they can do it, right? Now you need a financial system. Let's assume in these slides, why do we need a financial system? Now you know economic system. Let's assume there's a business opportunity, startup opportunity. You could develop a iPhone app, right? So if you have all technical knowledge, everything you have, but only thing is you don't have money to invest. But let's assume Chaminda has money to invest, but he has no idea about this developing iPhone app. Right? Now, if you can meet Chaminda and ask him to put some money, investment, right? So you can meet your needs by transferring funds. Now, when I say Chaminda has money, we can call him as a surplus unit. Let's assume Gavin, other one, okay? He has all technical knowledge to develop iPhone app, but no money to invest. He is a deficit unit. Now the problem is, if they cannot meet each other, there will be idle fund, right? Here, the economic system not properly working because there's no efficient allocation of resources. You don't get maximum output. But if you like, both of you all can get together and do this stuff, that means surplus unit and deficit unit, if they can get together, and if the surplus unit can invest on this project or like lend to the deficit unit, you can have more output. To do that, you need a financial system, right? Basically, in an economic system, you may be having surplus unit. In other hand, you may be having deficit unit. Unless they meet, you don't make efficient use of that capital. So now the question is how they can meet. In this economic system, the households, some of them, they have, right, surplus fund. They have to make investment on firms. How? Now the problem is how to see those deficit unit, how to understand their requirements, right? How they can or you can fund to them. These are the questions. So if there's an efficient financial system, this can be done easily. That's what in an economic system, you need an efficient financial system, right? Up to now, are you all following?
Yes.
Yes.
Okay. Right. Now, you know why we need financial system now. Two ways. One is, if you want to buy goods and services, you have to pay for that. How you are going to pay? That's one question. And second, you have the saving. You are going to invest on firms. How you are going to do it? These are the two questions in this economic system. So we need a financial system to facilitate those payments as well as these investments. This is what we are going to study, expand our observations, right, or understanding. So next section, I'm going to talk about an overview of the financial system. Now, you know what is economic system, what's the basic problem, how that works, and how a financial system can facilitate to that economic activities. Now, if you see this one, this is exactly which is available in the book as well, right? In a financial system, I said there are two parties always involved. Who are they? Rangana, who are they?
Financial institution.
Anybody else?
Savers.
Exactly. So one is a deficit unit, other one is surplus unit, right? Whoever having money, extra money, they are surplus unit or savers. They are the people like going to supply funds. Other side is deficit unit, lack of money, right? They are the borrowers. Now the problem is the surplus unit, the supplies of funds. Who could be? Example, in an economy, who can be a supplier of funds? Anuradha?
Deposits of individuals, extra savings, and profit or reservations of business units. Likewise.
Exactly. One more. Yes. Savings of individuals. Right? What do you mean by saving?
Excess from expenditures.
Yes, we could say. Okay. It's kind of, when you say serving the individuals, actually it's a postponement of consumption, right? Today they get income. As I discussed earlier, the needs and wants are unlimited. You don't have excess at any time, right? Kind of understanding, right? But they postpone their consumption. Okay, I don't want to consume today. I will consume this one, after some years or some months or few days. That is the serving, right? So why they are serving? Because like it's an accumulation of wealth. They wanted to prosper. They wanted to increase their income in a rapid way. So they would like to save more. When you say saving, they sacrifice today's consumption for tomorrow's, right? Individual savings. Very good. So when it comes to businesses, that could be profit, right? They earn more than their expenditure, so they have profit. So then their surplus unit. The third one is a government. What do you mean by government? So what is the surplus from? How do you say government is in surplus? Gavin? Surplus unit. When can you say government as a surplus unit? Take it, Sri Lankan government is a surplus unit. Go ahead, Gavin.
like investing on small businesses, things like that? Is it? I didn't exactly get.
I'm just talking about the surplus unit. How do we identify surplus unit? Okay, individuals, if they have serving, it's a surplus unit. Businesses, if they have profits, that's a surplus unit. So that means they can supply funds to others. When it comes to government, how you're going to say whether it's surplus or deficit?
Texas.
Okay.
Yeah, like having
Go ahead.
yeah, I guess like having more income than expenditure in the country.
Yeah,
Something.
how do you say that one? What is the name you call it? You're right.
Balance of payment.
Balance of payment is different.
Surplus of Texas.
Surplus of taxes, not exactly.
Budget surplus?
Exactly, Anuradha. Is it Anuradha or
No, sir, I'm Dilshan.
Dilshani? Very good. That's a budget surplus. What is mean by the budget of government? So they get the income through taxes. They do expenditure by consuming, goods and services, or like provide reliefs and all. They have expenditures. If the income is more than the expenditure, we don't call it profit. We don't call it saving, but technically we call it budget surplus. Here, like, underlying, like, understanding may be similar, but I just wanted you all to have, perfect wording, that is all about economics, right? Perfect wordings for each and every items. Yes, if a government is having a surplus, budget surplus, so it's a surplus unit. If you take China, might be a surplus unit. Annually, they may be having budget surplus, right? But if you take Sri Lanka, a budget deficit, so then deficit unit. So suppliers of funds can be individual, can be businesses, can be government. On the other hand, this deficit unit, demanders of funds. Who is going to demand funds? Deficit unit. Those can be individuals, similar, same, right? Individuals, maybe Rangana may be surplus unit, I may be deficit unit, but individuals, right? Or businesses. Who can be a deficit unit? If you take business, if they make profit, it's a surplus unit. If they make loss, it's a deficit unit. They have to borrow, right? And if a government is deficit unit, what do you mean by that? They budget deficit. They are having budget deficits. So this suppliers of funds can be individual businesses, governments. Similarly, the demanders of funds also can be individual businesses and governments. But the problem now is, okay, you know who is surplus unit, who is deficit unit. Now the problem is, in a financial system, how we are going to exchange these funds with deficit unit, or how we are going to make fund flow between surplus unit and the deficit unit. That's the question. That's what the previously also I discussed, I mentioned. If you take this economic system, the households, they have capital, how they are going to invest on firms. You need a financial system. In this financial system, we could think of few ways. Now this, okay, take it as an example, the individual, the household, they have surplus money. What they can do? The first, if you are taking like, okay, me as a surplus unit, I can directly lend to Rangana, right? So it's kind of private placement, right? Private placement. Or it's if you take the business, I'm going to invest on a business. You can see here the fund flow, surplus of funds, the surplus unit to deficit unit. You can see the fund flow. In a blue box, they have mentioned, right? It's a fund flow. It can go through individual to individual, or individual to business, or individual to government. Similarly, from business to business, or individual, or government to government, or government to business. If you take individual to individual, okay, between me and Rangana, or business, right? If I'm going to invest on dialogue, right? If I'm a wealthy individual, I can have private placement, right? When I lend to individual, they will give securities. What do you mean by securities? Anybody? Come on, Dilshani. I'm going to lend to you. Then in return, you have to give me something. We can call it securities, or maybe a provisional, kind of promissory note, right? You will say like, okay, I just owe you to this amount of money with this kind of interest in 3 months' time, right? We can call that promissory note as a securities. Or if I'm going to invest, it's a private placement. So directly I'm dealing with the deficit unit. If I'm going to invest on a business, let's assume Mr. Dhammika Perera is going to invest on HEMAS. He has surplus fund. So the HEMAS, it's a private placement. They will give securities, maybe share certificate. He is going to invest on equity. Let's assume Chinese government is going to invest on Sri Lanka, where you will have, if it is a loan agreement or investment agreement or whatever it is, you will have an agreement. That's the securities, right? So something from the surplus unit to deficit unit, something can be private placement or directly you are going to deal with. But the question is, can I meet Rangana? That's not possible. I have surplus money, but Rangana won't be seeing me. I may be from Colombo, he may be from Kandy. Can we meet? No. Can we exchange funds? No. We don't know each other. Even I don't lend him, even if I meet. Right? Is that okay? That's a reality, right? So even vice versa, Rangana won't lend to me. So then, in addition to the private placement, there can be an intermediary which can facilitate us to exchange our fund. That can be financial institutions. Now let's assume I take only households, because you always have that map in your mind. Simple economic system. So households as a surplus unit, you serve more, right? You have money with you. You can't meet deficit unit immediately. What else you can do? So you can go and park your money in a financial institutions. So you can see the upper part of this chart. It's a financial institution. The surplus funds go to these financial institutions. Now this financial institution take this all money and invest on deficit unit. Right? If you take the first part of these transactions, you park your money in the financial institutions. The financial institution can give you deposit certificate. That's a security. That's the agreement. Okay. So the bank will say, okay, after 3 months, I will return this money with this much of interest. That's a certificate. Right? So taking that money, the finance institution, now they have, we will discuss later part, right? They have their expertise on lending, right? They can easily find this Rangana. So then they can fund to deficit unit. The fund will flow. Then it's a loan. You will have a loan agreement. So that's a security. Right? So if you don't have a private placement, you can go through finance institution. So in a financial system, you can directly exchange your fund, or you can exchange your fund through financial institutions. There are third way. There's a way, another way, right? So you don't go to financial institutions, you don't do it private placement, but you go through financial markets. When you say financial markets, the key markets are money markets and capital markets. That means short-term markets and long-term markets, right? This surplus unit can lend to deficit unit through financial markets, right? It can be money market, right? Or it can be capital market. So fund will go through that market to the deficit unit. So deficit unit will provide securities. Take an example. If there's an IPO, right? So Dialog is going to have IPO. They will issue securities through capital market and you invest on that. Right? If like a transaction between two banks, maybe an example, two businesses. When you say like banks, those also business establishment, right? So if they want money, right, short term, overnight lending, the bank A can lend to bank B through money market. So ultimately, if you want to exchange the funds between surplus unit and the deficit unit, then you should have this kind of system in place, which is called financial system. Is it clear? Up to now you know what is economic system. Two players. Now they have, like, you know, surplus unit and deficit unit. They are going to exchange the fund surplus between households and firms. How they can do it? These are the ways: through financial institutions, through private placements, or financial markets.
Can you
Okay.
explain more about money market and capital market, please?
Okay, here I think you might have discussed. I couldn't see who is this. Anyway, you might have already studied this money market and capital market in the previous discussion, isn't it? I couldn't see who asked this question. If you can ask me the specific question, so it's a broader one you're asking. Hello.
Yes, actually, that's just I wanted to know about the little. I mean, let's briefly explain about these two. I mean, the money market and the capital. Just briefly explain about this, the area where we discussed this financial and the financial market.
Yeah. Yes, Rajakarna. Now, when you say financial market, right? So what does market means? Okay, in a good market, we usually learn the place where the buyers and sellers meet. That's a market. In a good market, right? If you just go to a market, you are the buyer of goods, and you go to the market and buy stuff, we are the seller also selling the goods, right? That's a market. So when it comes to financial market, it's a borrowers and lenders. That means surplus unit and deficit unit. They are going to meet up, right? It can be a place, it can be a virtual one, or like even over the phone, right? So say an example, if a commercial bank treasury person, he wants to have $1 million from maybe HNB. He make a call, right? Come on, I need 100K from you, or okay, 1000K from you, USD for 3 days, right? So then HNB, if the rate is okay for him, so he lend, right? So it's, even though it's a virtual one, it's a market. If it is a below 1 year, the transaction is like, below 1 year tenor, it's a money market, we usually call it, right? If it is more than 1 year tenor, we call it capital market. Now let's assume like I'm going to invest in a JKH stock. That's the infinitive. There's no tenor. Until the company is there, you will be a shareholder. You will be a owner of that company, right? So then it's a capital market where the financial the instruments are like longer tenor, maybe debenture, maybe shares, right? Even mortgages, mortgage debts, right? More than 1 year. But if it is money market, maybe some commercial papers, right? So money market lending, borrowing and lending between banks, those are coming under money market. So when you categorize, it's a below 1 year tenor is a money market, and over 1 year's capital markets. So if the surplus unit is going to invest on a below 1 year instruments, right, it's a money market. As an example, usually we call it money market when the market deal with banks, financial institutions. It's overnight, weekly, like that. But when it comes to capital market, you can say examples, Colombo Stock Exchange, it's a capital market where you deal with long-term debt instruments, equities, right? As a surplus unit, I can go and invest on equities. I can go on to invest on debt instruments. Those are listed under capital markets. But money market, very short term. Is that okay? Did I answer your question?
Yes. Yeah. Thank you.
Okay. Now, okay. Now, this is the financial system we need to, efficiently run the economic system. Now, what is financial system? Finance system is a system, right? Collection of households, firms, governments, right? That facilitate that, fund flow or channeling funds from surplus unit to deficit unit, right? So we need a financial system If you can understand that, that's fine. Now the problem is, okay, when I say financial system, what are the basic components we need to have in a financial system? Now you know what is economic system. Second, you know what is financial system. Now I am asking, what are the components, the basic component should be in a financial system? Okay, so there are 6 basic components in a financial system. The one is money, second, financial instruments, third, financial markets, fourth, financial institutions, and fifth, regulatory agencies or regulations, and sixth, central banks. This is, I have given whatever given in the books, but some of like few other books even say, in addition to this, payment and settlement infrastructure or regulations separately and regulators separately, but you don't need to worry about that. These combine all those items here, right? If you again recall this economic system, when you buy goods and services, you have to make the payment. That's a medium of exchange, right? You have to make the payment. So you need money. Is that okay? The one basic component on a financial system, it's a money, right? The second, now you can see here in the previous slide, okay, surplus unit. You take this as well, right? You need money for this payment. These are funds, right? Second, you need financial instruments. When you say financial instruments, assume shares, debt instruments. I have excess money. I'm a surplus unit. I'm going to invest on a company, or it can be a share, equity investment, or I'm going to lend, maybe debenture. So these shares and debentures are financial instruments. So that should be available in a market or financial system. Let's assume there's no shares, there's no financial instruments. How can I invest? I have money, but how can I invest without a financial instruments? Nobody is going to give you a share certificate. Nobody is going to give you debt instrument. So you have no way to invest. So in addition to money, you should have financial instruments. Then you can't directly meet the deficit unit. So you should have financial markets where you can find the deficit unit or surplus unit. So it can be money market or capital market. To buy and sell your financial instruments, you need financial markets. Then you need financial institutions. If you can't go through the market, yes, of course, the finance institutions open the door to access the finance. Not only finance, but also they provide informations. Clear? Right. And then regulatory agencies. Once you have these components in place, you have a complete financial system, but still you have an issue. Who is going to regulate? Because like in a surplus unit, in a finance system, surplus unit is going to lend money to deficit unit. If I am to invest, somebody should guarantee that, okay, this financial system is very efficient and safe and sound. Then only I will make investment. So there should be some regulatory agencies and comprehensive regulations to provide oversight for financial system. Now, if you take, okay, whenever like foreign investors wants to invest in Sri Lanka, they will see whether the Sri Lankan financial system is efficient. If that is not efficient, it's not going to give you a proper return. Now let's assume like you are just making a check payment, right? If you're going to make a check payment, the receiver can get the money after 5 days. Is it efficient? No. Then I'm not going to make check payment. Then if I'm not going to make check payment, I don't want to do my economic activity. I don't want to produce because I can't make the payment, or I don't want to sell because I can't get the payment immediately. So it's the financial institution and then regulations or regulatory agencies should be properly facilitating these financial flows. And then central banks. When it comes to central bank, that is there to stabilize the economy or monitor financial institution continuously. Actually, this is, as I said, the text from the book. So it's mostly relevant to US market, US economic system and US financial system, right? So now you have to think about what's happening in Sri Lanka. Who is the regulator of banks? Kunanayagam, who is the regulator of the banks?
Central Bank of Sri Lanka.
Yes, Central Bank of Sri Lanka. So regulatory agency for banks is Central Bank of Sri Lanka. For insurance companies, those also financial institution. Gavin, who is the regulator?
Central Bank of Sri Lanka.
Not for insurance companies.
Sri Lankan insurance, is it? No, I can't remember.
Anybody else? Dilshani?
Insurance board.
Chamin, the insurance board previously, now name changed. Early insurance board of Sri Lanka, but now name changed. Sri Lanka Insurance Regulatory Commission. Who is regulating Colombo Stock Exchange? Those are financial markets.
Securities and Exchange Commission?
Excellent. SEC, right? If you take Sri Lanka, the financial system, Sri Lankan financial system, it's a multi-regulators. The central bank, of course, banks, finance companies, leasing companies, primary dealers, and all. But if you take insurance companies, insurance brokers, and all, that is insurance regulatory commissions. And if you take stockbrokers, Colombo Stock Exchange, and all, it's SEC. So it's a multi-regulatory system in Sri Lanka, right? But if you take US, actually like central bank, we call it Federal Reserve. They don't regulate financial institutions. There's another body to regulate. That's what in this textbooks, okay, regulatory agencies and central bank also give, right? So that's what I have given in the bracket. Okay, in Sri Lankan context, central bank itself regulate the banking sector, but same time, it's looking at supervising a financial institution and stabilize the economy, the financial system overall, right? The final one is central bank, as I said, right? It's monitoring financial institutions and stabilize the economy, right? So these are the 6 major components or 6 parts of the financial system. But if you see some of other text, they say, okay, payment and settlement infrastructure are one of the key components, right? Of course, that also there, right? So now if you want to make a payment through a credit card, you should have a system in place. That's also part of financial system. So that also can be included. So regulatory agencies, regulations, and central bank, in addition to that, you can think of payment and settlement infrastructure as well. So you could see now, based on this picture one, the previous slides, the important components, right? You should have money, you should have financial instruments, you should have financial institutions, you should have markets, and to regulate all these items, you should have regulations and regulator. And to see the financial system stability in overall, you should have central bank. So in this picture, we'll give you the components of a financial system. And to make this fund flow also, you have to have payment and settlement infrastructure. Now let's assume you are going to make a deposits fund, right? If you have online banking, you can do it. If you want to withdraw money, ATM, you can withdraw it. So that's also part of financial system, right? So now you know what is economic system, what are the activities it's carrying out, how this financial system supports, and what are the major components of a financial system. Is it clear? Chaminda, is that okay?
Yes, sir.
Okay. Any questions you can interrupt. Like if you can just think of Sri Lankan financial system now and see how that works with these theoretical discussions. Okay. So now first one, I said money. Any question? I think somebody's mic is on. You can ask any questions if you want. Okay. So then the first one is money. Money is very important. When it comes to other chapters, actually we will be dealing more on money, right? So you should understand what is money and how that works. So first one is meaning of money, right? You could see anything that is generally accepted in payment for goods and services or repayment of debts. It's a legal tender, right? You can use this as a medium of exchange to buy goods and services or repayment of debts, right? This is the meaning of money, right? So what are the functions of money? Have you done this one earlier, previous discussions? Anybody? Have you all already discussed this one? I just want to, if you have already discussed, so we can just, simply just have a touch and go. Gavin?
No, sir, we did not discuss.
Okay. So can you, anybody tell me what are the functions of money? You might have discussed this in our high schools. And rather,
Basically, it's a medium of exchange, and then it has a storage value, and
Good, excellent. And now, basically, as you said, first important function is medium of exchange or means of payment. What is that? Now, if you take the barter system, the before money comes in, right? So you have to, exchange goods for good, right? So the problem was like double coincidence of bonds, right? So that means like you have like, let's assume like I have rice and you have dal. If I'm going to exchange this one, you might be able to get rice from me. At the same time, I also want to have dal from you, right? Double coincidence. So then if that is not there, you can't exchange your goods, right? But when it comes to money, it can act as a medium of exchange. If I have money, if I want anything, I just give the money and get it. Then he has the money, so he can go wherever he wants and get the stuff, whatever he wants, right? So it's a medium of exchange. That's a first function and very important function. Second, unit of account, right? When you say unit of account, right? Okay, if somebody come and ask you, okay, you have dal, how much is it? Oh, what's the worth of this? What's the value of this? How you are going to say if there's no money, right? So unit of accounts facilitate to you like, okay, give a price, quote a price. Or if you're going to do some accounts, it gives you the ability to do accounts, right? So it's a unit of account. That's a second function. And then third one, store of value, right? So now example, now I have purchasing power today. That means, okay, I have enough money today. But the problem is I wanted to have consumption after some time, not today. So I want to serve my purchasing power for the future. So money does that. Example, in a barter system, okay, you have a whole lot of vegetable this month. But if you want to have that vegetable for next 3 months as well, can you do it? No, you cannot store your wealth. But here, if you have money, then you can sell it for, right, money and get the money and keep it. It's a store of wealth. Okay, a means of payment has to be durable and capable of transferring purchasing power from one day to the next. So today I have purchasing power. It should be, used in the future as well. So that money does that function as well. Not only money, there can be other instruments can do the same thing, but money is the key. Okay, so as I said, okay, other instruments also can do the same thing sometimes. Okay, take an example. If you take a stock or bond, treasury bond, I can invest on treasury bond. I can store my wealth there, or any other bond. I can get it back whenever I want. But people prefer money because of liquidity. Anytime you can convert that into any assets for whatever goods and services you want. That's what people prefer money. Right? Is that okay? Up to now, is there any question? Is that clear? Okay, so now we have seen the 6 components. Out of that 6 components, sorry, I couldn't hear you. Okay, up to now we have seen the 6 components. Out of that, the money, and the functions of money. Very important. Later part of our discussion, monetary policy, right? We'll be focusing on that, right? Okay, and also we should know the evolution of the payment system. As I discussed earlier, in the financial system, the payment system is key, right? Where the money become a medium of exchange, right? Now we are going to see the evolution of the payment system. What is payment system? It's a arrangement of kind of web of arrangements, right? Which allows exchange of goods and services as well as assets, right? Through this payment system, right? Without the payment system, you cannot do the exchange of goods and services as well as assets, because like you have to pay, there should be a payment system. So when you take the payment system, right, as we discussed earlier, money is the key. Right? In the current environment, the possible payments may be fiat money. Right? In the barter system, we used, or like even later part, we used commodity money. Anybody can give me some example in commodity money? Nobody? Why don't we discuss? I think most of you all are like working in a bank, so bankers are very talkative. So why don't we talk more? Otherwise, 3 hours in a row, sometimes it's very difficult to, concentrate. Chaminda, can you tell me some commodity monies used in the past?
Gold.
Oh, and rather, sorry. Yes, Chaminda.
Gold, sir.
Yeah, some precious metals. Yeah, gold, maybe silver, bronze, maybe those kind of metals they used. That's a commodity money. And not only that, those days they used salt, right? Or some kind of seashells, right? Precious stones, right? Those can be a commodity money. Then what happens? After some time, fiat money comes. When I say fiat money, it's the money we used currently, or paper, right? Or coins, right? So this came into financial system, right? So it has a legal tender. It's actually issued by the government, right? Paper currency we used, right? So after that, we also could see checks, right? One is now currently we could see fiat money, that you can say currency notes and coins, and then checks, right? You know what is checks, right? It's an instrument like we used to write and give it to somebody, so then they can use that to credit their accounts or debit our account, right? A check is an instruction from you to your bank, okay, to transfer money from your account to someone else's account, which she deposit the check, right? So when you have current account, you can write the checks, right? That's also like after this currency notes and coins, you had checks, right? Still we are using. And then next jump is electronic payments, right? I'm just discussing here like key items only. When it comes to electronic payments, it can be credit cards or debit cards, or electronic fund transfer, or store value card, or currently it's a e-money, right? So now money is evolving, right? That's what we are having complexities more and more. Earlier we had money or commodity money, then fiat money, then we had checks. Now we are having electronic payments that can be credit debit cards, electronic fund transfer, store value card, and e-money. Right? So you know like what is debit card, right? It links to your bank account. Whenever you use this debit card, you can withdraw money or you can do purchases, goods and services. So that's debit card, right? So you know credit card. These are electronic payments, right? So when you use the credit card, of course, bank promised you to give or lending some money, amount of money. Whenever you use this credit card, okay, they lend you, right? Okay, that is credit card. Okay, and then electronic fund transfer, that you know, right? You can do fund transfers electronically, right? Here what I have mentioned is automated clearinghouse transaction. It's in US, right? Here also we have clearing transactions, so that means Lanka Clear and all, right? It works electronic fund transfer. If you want to do kind of RTGS, real-time gross settlement, right? If you want to transfer fund from one person to another person, or one account to another account, you can use RTGS. Or one bank wants to have a fund transfer to another bank, it may be a significant or like large value transactions, then you can do RTGS transfer, right? This is electronic fund transfer. Even in your personal account, you can do it. So the payment system evolved, and then a store value card came. So that means you can have the card, it can be issued by banks or merchants, right? If there's a merchant, like he can issue a card, you can top up that card with the bank or ATM. And whenever you want to purchase goods and services, you can use that store value card, right? In some restaurants in I don't know, in Sri Lanka, in abroad, like, you know, they have the cards, food court, or like shopping mall, they have the card, and you can top up and you can go and buy whatever you want with that card. It's a store value card, right? So finally, e-money, it's a electronic money. It's very difficult to define electronic money. Even some text says, okay, debit card, credit card, also like kind of electronic accounting your money, so you can use that as well under e-money. But basically, it's a electronic money. It's basically, you know, like it's issue money in electronic terms. You can take as an example the ECP, or your now apps are coming. You can store money in your phone. It's e-money, electronic money. Whenever you want to make the payments, you can use your phone, right? Even if you take here like local apps, right, they will transfer some of your money to the phone. It's a e-money or kind of e-wallet, you might have heard. Then you can use that e-wallet when you do the purchases. As a famous one is M-Pesa in Kenya, because like 70% of the population is using that M-Pesa in Kenya. So it's a e-money, basically, like you do the transaction through mobile phones. Even sometimes you don't need to have bank accounts, right? So this is the evolution of the payment system. Now you should know not only money, there are functions of money, but those functions can be done by any other instruments as well. Is that clear? So silent. And Radha, is that clear?
Yes, fine.
Okay, good. Now, you should keep in mind, okay, what is the economic system, what is financial system, and what are the components, and the key instrument is the money, but now it's changing. That's what I wanted to know, or like, you all to keep in mind. Now it's changing. It's definitely in future also, everything will be changing. Sometime you may not be having money. Now, this during the corona, we are using a little money by our hand. Everything is online or e-money, right? Or store value card, debit, credit, of course, whatever it is, right? We don't use it. Clear? So maybe after 10 years, even we may not be having, in the sense, we may be having only little money in our hand. So everything is changing. Then our financial system will be changing. That would promote economic efficiency, right? Let's see. This is very important, because when we are going to discuss the monetary policy, right, you should have this idea in your mind. Just to share with you, right, few questions. In Central Bank of Sri Lanka, okay, it has two core objectives. What are those? Anybody? Dilshani?
So what was the question? My connection broke.
Okay, so if you take Central Bank of Sri Lanka, there are two core objectives. What are those?
I think one is to for the printing of money, central bank, and one is that, and then it acts as the banker to the other commercial banks. And then central bank is also the lender of last resort.
Okay, Dilshani, I'm just okay. You are listing out the functions of central bank.
Yeah.
What I'm asking is the two core objectives of central bank. Okay,
sure.
good.
Yeah.
Anybody else? And rather?
So ensure the financial system stability and not allow to derail the system to financial institutions.
Good. One is correct. Perfect. What is the other one?
No. Concern on price stability. I mean that in the economic system stability.
Exactly. Now you're almost there. There are two core objectives of Central Bank of Sri Lanka. One is economic and price stability, and second is financial system stability. You could see here, like I saw you earlier, right? In this, I have given a central bank. There I have mentioned to monitor financial institution and stabilize the economy, right? Central bank, right? Okay. So what does that mean? Now, actually, if you take Central Bank of Sri Lanka, it has two core objectives, right? One is economic and price stability. That means to maintain economy as well as price stable. Price should be stable, right? That means not highly fluctuate, right? That's one. And second, financial system stability. That means the Sri Lankan financial system should be able to withstand with any shocks, maybe internal or external. So there should be a stable and sound financial system in place. If you take some other countries, if you take Australia, right, the central bank's objective is towards price stability, not financial system. There's another entity, regulatory entity, is there to look after, right? So this is varies to country, but when you take Sri Lanka, the both are looked after by Central Bank of Sri Lanka, right? So when it comes to price stability, what do you mean by that? Anybody? What do you mean by price stability or stable price? Okay, when it comes to price stability, right, you should have a stable price. That means no high fluctuation, right? So you cannot have a different price or like today, tomorrow, like highly fluctuated price, because we know in an economic system, you cannot make the decision. Let's see, like firms are providing goods and services. Today, maybe one loaf of bread, 60 rupees, and tomorrow maybe 100 rupees, and day after tomorrow maybe 40 rupees. It's highly fluctuated. Can a household make a consumption decision? Can they forecast a consumption decision or saving decision? So like postpone their consumptions? They cannot do that. So if economy should perform efficiently, you should have a stable price. Or investors, let's assume like household wants to have investment on firms. If you don't know the price or future price, or if it is highly fluctuated, you cannot make an investment decision, because today may be one price and tomorrow may be another price. So that was that is the reason, like always central bank mandated with price stability. That is the key for any central bank if you take around the world. Maybe Federal Reserve in US, maybe Reserve Bank of India in India, maybe in China People's Bank or Bank of England. Their primary focus is to have price stability. Even you can see like in the recent roadmap of Central Bank of Sri Lanka, you can see the price level should be mid-single digit, right? So when I say like, okay, the price is volatile or price is unpredictable, what is mean by that? Okay, now let's assume like, so every day prices increases in a significant way continuously. What does that mean? Anybody?
Inflation?
Exactly, Gavin. I'm talking about the inflation. What is mean by inflation? It's a price increase continuously, right? So then central bank is mandated to have, right, low and stable inflation. That is price stable price. When you have like low and stable inflation, so that means it doesn't mean like price is not increasing, price increasing, but by a very low rate, and it's always stable. Maybe 2% annual, maybe 3% annual. What is the central bank statement, latest statement to have inflation at? What's that? Anybody listening to announcement of central bank? What is their comment on inflation? What is their target? To maintain inflation at mid-single digit, maybe 5-6%, around 7%, or below 10%, right? Single digit. So always the central bank, they wanted to have inflation low and stable. Then only, the agents in economic system can make effective decisions, right? So when it comes to, what do you mean by inflation? I already told you. It's an increase in the prices, general price level continuously. How do we calculate general price level? Anybody knows what is general price level? Okay, I don't want to go into details. What I want to stress here is, like, when it comes to inflation or price level, the final you are going to come back again to this money, discussion of money, right? Then we should know all about money, how that change over the period, right? So how central banks cope up with these changes, that's very important. So keep in mind, always the inflation is very important factor that is stimulated by so many other factors. So when we study the monetary policy, we will remember this as well. Clear? Is that okay? Up to now is okay? The next slide, you can see the future of the three functions of money. What will happen in the future? It's actually that from the textbooks. So means of payment, one, disappearing due to ease of electronic transactions. Now, when you do more and more electronic transactions, you don't need the money. Hold on for a while. Okay. Now, first one, as we discussed, when you do electronic transaction, you don't need this money. So in future, this may be disappearing. And then unit of account. Whatever happens, you have to have kind of accounting and quoting prices. So definitely, you may be having this one continuously. But store of value, that might be disappearing due to new financial instruments, right? Now let's see, those days, I don't know, you could remember, if you deposit in a saving account, what's the in a withdrawal pattern, what's the difference between current account and saving account deposits? You have deposits in current account, you have deposits in saving account as well. When you withdraw, is there any issue? Anybody here? What are the differences in withdrawing money from current account and saving account? Raja Karuna. Do you see any differences? Oh, Gavin?
I have no clue, sir. I have no idea.
Okay, no issue. Now, the thing is, when you say current account, okay, by writing a check, you can withdraw immediately. There's no issue. But those days, you are not able to withdraw saving account immediately, right? Even time deposits before maturity, you are unable to withdraw from the fixed deposits, right? So nowadays, by writing a check, you can withdraw money from current account. By writing a slips, you can withdraw immediately through saving account. Even with the notice, right? Even you can withdraw money from your fixed deposits. Now, why I'm saying is, now those days, only cash and checks are highly liquid instruments. But nowadays, when it comes like, economic system changes, now saving account also seems to be highly liquid. And in short-term deposit or whatever, that also becoming a very liquid, instruments. So when it comes now, you can see those days, if you want to make any transactions, you used to have money with you. If you take salary 30,000, right, those days, you may be 60-70% of the money you may be having as a money, because you need liquid assets. You think that's the only liquid assets. You can buy anything through that. But now that is not the case. You park your money in the saving account. Whenever you need, you can do transfers. You can do anything. It's also seemed to be now liquid. So when these kind of new instruments are coming, right? So then store of value may be disappearing. We don't need to have money for store of value. We prefer store of value. There are so many instruments you can have it. Bond, right? Or any other instruments in addition to money. But if those are very liquid, why we are going with money then? Because those instruments give return as well. So sometimes when the financial innovation happens, so you will have additional financial instruments where that can be act as store of value. So in future, nobody knows, but according to this text, it says, okay, unit of accounts may be prevailing, but others may be disappearing. Is that clear? Any question? Okay. So now the question is, how do we measure money? Anybody is having any idea measuring money? So silent. Okay, again I back to the discussion on inflation, right? What is inflation? And rather, what is inflation?
Frequent increase in prices.
Okay, but in a kind of academic way, if you want to give that answer? Oh, Gavin?
Some kind of a uncontrollable price increase. Still.
Yeah. Okay, I just okay. Please go through the textbook if you have time. It's better because as a bankers, you should be able to talk in a sense like it's a way of academic, kind of elaboration should be there that can easily convey the message in a precise way and accurate way. It may be very helpful in your career, so that's what I'm just I'm accumulating all these relevant ideas into this subject. So when you say the inflation, it's a continuous increase in general price level. These are very important, wordings. They are continuous increase in general price level. The increase should be continuous, and then which increase? It's a general price level increase, right? So what do you mean by general price level? How do we calculate general price levels? Okay, countries. You take this country, Sri Lanka. How do you calculate a general price level for Sri Lanka? Anybody else? I think anybody can contribute to the discussion. Chaminda? Come on, it can be right or wrong. It's kind of discussions. Then only we can learn, right? Chaminda or Rajakarna?
With compared to Colombo consumer price level?
Exactly, you are right with the examples. Okay, so when it comes to general price level, how do we calculate in Sri Lanka? Not only Sri Lanka, every country, we have a mechanism to calculate, right? What is that mechanism? Like we take basket of goods, right? We take a basket and put like very important goods into that basket. Let's see, maybe rice, maybe sugar, maybe fuel. We put everything. So these are our basket of goods. Based on their importances, we give some weights to them and calculate the prices and arrive at a number. That is the general price level. Let's say 3,000. Now that after calculating these prices, weighted average prices, we arrived at 3,000. That's a number. That's the general price level in Sri Lanka as of 2021. Maybe September. Now you again, next month, you calculate the same basket of goods. You put the current prices, weighted average prices, and calculate. Now 3,050. So now the general price level has increased by 50. That is in October. Maybe in November, we calculate again. So it's now 3,100. So increased by another 50. So again, every time when you calculate, the general price level is continuously increasing, right? So when the general price level is continuously increasing, that is we call inflation. right? So if it is 3050 and 3020 and 2990, so like that, if it is going like that, right, it's not a continuous increase, right? So there can be 2%, 1% increase, not significant. So there's no low inflation. We can't say no inflation, it's a low inflation, right? If that is continuously increasing, so that's a inflation. That's the definition for that. Now my question is, how that happens? Why inflation happens? Why we encounter with inflation? What's the reason behind that?
So is it like something related to appreciation or depreciation of the value?
Why? Okay, we go into directly to that point. Okay, why prices increasing? Why prices are increasing? Come on, you have to tell me. Now during this corona and this period, we are learning a lot of things. We are experiencing a lot of practical issues. You should be able to answer.
Due to high demand.
Demand for what?
For goods and services.
Okay, so high demand means you have limited goods and services. There are high demand. How this high demand happens? Okay, so in a way, the demands coming from the people who has money. If you have more money, your demand is high. Is that okay? Okay, let me tell you an example. Now take Sri Lanka as a whole. The total production of Sri Lanka, is there any other word we can call it? The total production of Sri Lanka?
The GDP?
Yes. Our total GDP of Sri Lanka's total GDP, maybe one loaf of bread. Okay. Now central bank printed money, 100 rupees. Right? Now total production it's a closed economy. You don't need to worry about that. It's a basic economy. The total production is one loaf of bread. The central bank issued only 100 rupees note. What is the price of this bread? Now, I have that 100 rupees. As a household, I have 100 rupees with me. You firm produce one loaf of bread. What might be the price for this one loaf of bread? Nothing else.
100 rupees.
Exactly. So I will give my maximum price to buy that because that's the only product available. So I'll go with 100 rupees and buy that one loaf of bread. Clear. Now what's the price level? 100. Now central bank print another 100 rupees the second year, right? So 200 rupees in the market. So I have 200 rupees. So the firm produced one loaf of bread. Now, what is the price of the bread?
200.
I have 200 rupees. So think like that. So now 100 rupees worth of bread become 200 rupees. If it happens like continuously, what we can call it? It's a inflation. Inflation, we can say in other words, the continuous chasing of money, the chase of money to the goods and services, right? So money will be chasing the goods and services continuously. So when you have more and more money and the product, goods and services produced is same, you will have inflation. Now the problem is, if we want to have same price, no inflation, you should issue currency similar to your production of goods and services. If you want to have, let's assume, if you want to maintain your price level 100 rupees, the total production of the country is 1 loaf of bread. How much money you can issue? Anybody? I am asking the same question in reverse order. You want to maintain price level 100 rupees. The GDP is 1 loaf of bread. How much a central bank can issue money?
Same, right? 100 rupees.
100 rupees. So now the challenge is with central bank. They have to, because it's a forecasting arrangement, they have to forecast how much would be the GDP. So how much money needed by the economy, right? Let's assume this time you may be producing 2 loaves of breads. If you want to maintain 100 rupees price as earlier, how much money should central bank should be issued? Now production is 2 loaves of breads. You want to maintain 100 rupees. You don't want any changes in the price. How much money a central bank can issue? Gavin, how much?
200, right, sir? Because
Exactly, 200. So then price is not changing. Now the challenge central bank is taking is you have to forecast the GDP and you have to issue currency based on the forecasted figures. If the forecasted GDP is wrong, right, you can't control your inflation, right? And same time, I'm thinking money as a medium of exchange. Only you can use money. If you can use other than if you can use any other instruments other than money, then it's more difficult central bank to think of how much money needed to buy the stuff. All are with me? Maybe this genre you never thought of, but this is the basic. Is it clear? So it's all inflation right? Price stability and price of goods and service is based on the money issued by central bank. That means money supply.
So again, like this is solely based on money, right? Or like
Yes.
are they? Yeah.
Go ahead. Yeah, I didn't get your point exactly what you want to say.
Like no. So what I asked was like it's solely based on like the circulation of money, right? No other form of like some
True. Now
like other financial instruments, no, right?
no. The thing is, this is I'm talking about the basic structure solely based on the money. But the problem is, in practical sense, this can be different. But now currently what I'm discussing is it's a very basic thing. Forget it about anything else. Now the question is, okay, how do we measure money? That's our title question, the basic question, overall question. That's what I brought in this one. Now you need to measure money in order to keep your inflation, your prices of the goods and services. You have to measure money because the central bank should think of how much money I should issue to keep this price of this one loaf of bread at 100 rupees. So you have to measure money. So measuring the terms, right? It's measuring liquidity. Because the public, general public, how much liquidity they have to buy these goods and services. We know money is most liquid assets. That's what we are talking about, money. But if there's any other item that is also most like liquid like money, then that also should be coming into this consideration. For time being, I leave it out. I talk only I discuss only a money as a liquid asset. So measuring money means measuring liquidity. In a basic economic system, without any sophistication, as you said, as Gavin said, right, is the how much of money in circulations, notes and coins. Clear? Okay. But when it comes to purchasing goods and services, the liquidity concept may be more than money. Maybe current account, check. You can, similar to money, you can write your check and give it to somebody and buy goods and services. Now, in addition to currency notes and coins, you also can take checking account. That means current account balances also as money, because that also highly liquid. Now in this figure 2.2, you can see some financial instruments in liquid order. First one is currency. It's like a water, more liquid or most liquid assets. So if you take demand deposits, it's also like highly liquid, but one notch below currency. That's kind of, we can compare with oil. Maybe saving account deposits, certificate of deposits, that you can compare with gelatin. But when you move from top to bottom, it goes like a high liquid to illiquid. The last one, maybe you can compare with brick or maybe real assets, lands and building. When you say liquid, the instrument should be immediately convertible at no loss or a small loss. If you take cash currency, it's mostly like top of this liquid list, and then one by one going down, we can compare Sri Lanka as well. Now measuring money, which one you are going to measure? Currency, or currency plus checking account, or currency plus saving account? That is your question now. In an economy, now as I said, if central bank wants to take currency alone as liquid assets, of course they measure issued notes and currency. But if they think, okay, if I want to see this inflation or price stability, currency alone is not going to buy goods and services. Even balancing the demand deposits also going to be used to buy goods and services. So my money should include not only currency, but also checking account. This is the concept. Is it clear? If you are not clear on this, we can discuss further, because this is the basic. Anuradha, is that clear?
Yes.
Dilshani? Any doubts? Rajakarna, I didn't hear from you.
Very clear, sir.
Okay, good. Now, this is the way we have to think, right? So always keep that in mind when you say measuring money, right? Money can include or currency or checking account. It's based on how do you define, right? Okay, if you take this US, right? Different definition of money have based upon degree of liquidity, right? Country to country. Now you have to think from the economic system, right? This is what the problem comes. If you don't like have this mind mapping, everything would be confused, right? Kind of economics is a subject like always make people confused, because we can talk one variable at a time, right? Keep it in mind. If you think about other variables, what I'm saying may be different. So you may think, okay, this cannot be the case if some other variables are there. Now I am telling, okay, if when you take the money, currency and notes, compare with the goods and services, right? I elaborate with the price level. But in addition to that, if you think of like checks or saving account or debit card, credit card, you will be confused. Maybe, maybe other answers you will think of, right? That's what I'm thinking. That's why I'm telling, like, you keep in mind, it's a mind mapping I'm talking about. So measuring money is differs. Now you may be knowing country to country, it differs. Whatever I want, if you take Sri Lanka, to measure accurately the inflation, what are the items we have to take into as a money? It may be vary from US, because it depends on the structure of the economy and structure of the financial system. If you take US, different definitions of money are based upon degree of liquidity, right? That's what I have given here. Drawing the line in different places has led to several measures of money called the money aggregates. We call it monetary aggregates, right? So now, to go in line with our price level and the objective of price stability, we have to see which money is particularly used to buy goods and services. Here in US, they have two main categorization. One is M1, other one is M2. In Sri Lanka also, we are using the same categorization. But in addition to this, even M3, M2B, there are several categorizations. We can look into that later. Now, in this introductory discussion, I just want you all to keep in mind this basic stuff. When it comes to M1, it gives the list of items under M1. You can see. Under monetary aggregates, you can see M1 that includes currency in the hands of the public. That means currency, notes and coins. Traveler's check. If you have bought a traveler's check, that also coming under M1. Demand deposits. That means balances in the current account. And other checkable deposits, or similar deposits. These are M1 because it says like, okay, this currency, we can say M0 as well, right? Keep it in mind. M0 means currency, notes and coins, and M1 including that's currency, notes and coins, traveler's check, demand deposit, and other checkable deposits, right? So in Sri Lankan economic pattern, this can be or M1 or US pattern. So that means using these items, you should be able to buy goods and services. These are highly liquid, right? In addition to that, M2, that's a second aggregate that includes not only M1 items, but also small denomination time deposits, maybe 3 months, 1 month deposits, or serving deposits and money market deposits accounts, and then retail money market mutual fund shares. These are the categories. You don't need to worry about that. These are the categorization of US. What I want to say here is you have this monetary aggregates including different items as M0, M1, M2. So these are the measurement of money. Why we measure? Because we want to see the linkages between the goods and services and the price. Sometimes, if you take only currency, notes and coins, you may not be able to capture the relationship, because we discussed you can buy goods and services not only using currency, notes and coins, but also using checks. So how to measure money? That's a problem. So then when you say M1, that's the narrow money, right? You can see the items which is included there. Clear? Right? Any question on this? All are silence means you understood clearly, or so many confusions around this? Anuradha, is that okay?
Yeah, sir, narrow money stands for M1 only?
Yes.
Thank you.
So Sri Lankan categorization we can discuss later. It's M0, M1, M2, M2B, and M3, and M4 also we have. But when it comes to this inflation and all these analysis, we go into M2B, right? Because that is really in line with the, you know, price level and the impact, right? So it's country to country differs, right? That's what different countries have different classification and measuring money. So now you should understand here in this takeaway point is you have money, but measuring money is very different with the purpose. Yeah, and Radha, you want to say anything?
No, sir, no.
All right, thanks. So now you can see what do the monetary aggregates mean, right? As of winter 2010 textbooks, it says nominal US gross domestic product GDP 14.5 trillion in 2010, right? Using the data in table 2.1 above, right? This is the 2.1. Here we have given how much M1, right? In billions, that means 1.6 trillion, and M2 is $8.4 trillion, right? Here you can see, using the data in table 2.1 above, GDP is nearly 9 times as large as M1. M1, when you compare M1 with GDP, GDP is 9 times larger. We will look into that later, how this happens, because you have example, okay, 9 times, okay. You have 9 rupees in your hand, M1 money, right? Let's assume 9 rupees, but you do the transaction of goods and services worth of 81 rupees. That's 9 times. You have only 9 rupees, but you do the transaction with that 9 rupees. You do the transaction of goods and services which worth 81 rupees. Clear? Just to explain further to understand this, okay, I bought 1 loaf of bread giving 100 rupees. That 100 rupees goes to that seller. He come and bank that money, 100 rupees. The 100 rupees with the bank. Now that bank lend that 100 rupees somebody else. He bring that 100 rupees and buy another loaf of bread, right? So 100 rupees can be used for several purchases, same 100 rupees. I don't want to explain further. We will discuss later, but this is the mechanism behind that. So even though the M1 means currency notes and coins, checking account balances, traveler's check, if you take all together, the GDP is 9 times of M1. And the GDP is about 70% larger than M2. Right? The question is, which M do we use to understand inflation? This is what I was like, you know, step by step explaining inflation and the money. Now you arrived at the questions. Okay, you want to assess the inflation. You want to understand the inflation. That means how the prices of goods and services increases or changes. You want to understand the inflation. So which money you are going to take into account? M1 or M2 or M0? It differs country to country. Right? You can see until 1980, right? Both M1 and M2, right? Moving in a similar fashion, right? That's what in US, they used M1 until 1980. But thereafter, M2 and M1 are moving in different directions, right? So according to their experience, M1 become obsolete. That means they couldn't forecast inflation based on M1, right? So they move into M2, right? So it changes, it depends, right? Now there are so many tools available. If you are not able to forecast inflation based on this M1, M2 or monetary aggregates, you have to move into some other tools, right? So here question is how to measure money, whether that money help to understand the inflation. Sometimes maybe, sometimes may not. Is that clear? Or I'm just first discussion, I'm just giving so much of information. If you can understand and go through the slides again.
So I have a small question regarding this GPD and M1 relationship. How did that come to be, like 9
Okay,
times as large as?
I didn't get your point.
Like what is, how is this relationship built up? Like the GDP
Okay.
and the M1, it
Okay,
being 9
simply
times.
Yes, simply I will go with the previous example, right? So now, okay, now you have as a Sri Lankan GDP is 1 loaf of bread, right? And central bank issued 100 rupees currency, right? Okay, that is 100 rupees your M1. And GDP, total GDP also 100 rupees. So 100 rupees worth of currency in circulation, and you have 100 rupees worth of, that's a market value, 100 rupees worth of GDP. So it's a 1-to-1, right? Similar, like equal to the value of the GDP is equal to the currency in circulation, M1. Assume like that. But now, because of various reasons, as I explained earlier, the 100 rupees circulating among others and coming back to banking sector and all these happenings, leave it out for a while. Now your M1 is only 100 rupees, but in a little bit advanced one, right? But you have GDP, 4 loaves of bread, still selling at 100 rupees. That means your GDP is 400 now. Money in circulation is 100 rupees. So GDP is 4 times of your M1. Now you can ask, okay, you have only 100 rupees. Now 400 rupees worth of GDP is there. How you are going to buy it? Yes, I will buy 100 rupees first. The seller bank that money. Somebody else will get that money and buy it again. Hold on for a while. Okay, now that's circulating. The same money is circulating again and again, right? It's in a way we call it, I don't want to explain now, money creation. Right? Even though central bank issue 100 rupees, now it's market created into 400 rupees. Just an example, right? I didn't go into detail. Just think about that. So now M1 is 100, GDP is 400. So it's 4 times of M1. Is that clear? Is that okay?
Yeah, so that was clear.
Yes.
So it is 1:4 ratio they're considered there, right?
Yes.
So in that example, what you do? Yeah.
Yes.
Yeah.
So like that in US, it's 1:9.
Yeah, I got it, sir.
Yeah, yeah. So now the problem is all about inflation, all about price level. Now you have the GDP, other hand you have the currency or money. Which money to use to see or understand the inflation? That's the question. Everybody is having trouble with that question. Now let's say I will tell you simple example, in the sense, okay, you have you like next year you think, okay, there will be 100 kilos of rice, and you issue money, maybe 1,000, thinking like next year the price of the rice will be 10 rupees, right? But suddenly, because of the weather and all, you produce only 10 kilos of rice. You may be thinking, okay, next year the price will be 10, okay, tomorrow the price will be 10, but because of this climate, weather condition and all, your expectation went wrong. You produce only 10 kilos of rice. So now what's the price of the rice? 100 rupees. So it's not a simple thing to decide and go. So both ways we have to have a problem. We will have a problem. One is forecast your GDP, and second one is measuring your money. We don't know how that works, and we don't know like whether you are using currency, you are using your overdraft, you may be using some other instrument which is highly liquid. Nobody knows. In the sense, this what, in every central bank there's a department called economic research department. Their whole job is to study this one, right? What may be the future production, what may be the money or aggregate or components of money, how that works. It's not a simple thing. It's all with the assumption, right? Okay. Any question? Right. So if you see now, as I said, when the money grow, what will happen to the inflation? Money is growing now. Let's see, like we talk about, okay, central bank printing money. So when money grows, what will happen to the inflation? No answer.
So money growth in the sense like there's more money in the system, is it?
Exactly, money supply.
Yeah. Then it increases, right? The inflation.
Yes, inflation. That's what we have. Like currently, we are so many people talk about, right? When central bank prints more money, money grows, or money supply grows, right? When money supply grows, but on the other hand, you don't have increase in your goods and services production. Both are growing. Of course, your price may be like, let's see, 100 rupees you have one loaf of bread. So it's a price level is 100 rupees. You have 200 rupees today. Now today you have 2 loaves of bread. Now still your price is same. 1,000 rupees issued, or 10 loaf of breads you have. Price is same. But you are issuing currency. But nothing changed in the GDP. What will happen? It's only 1 loaf of bread. If you issue 100 rupees, it's a 100 rupee price. If you issue 200 rupees, now price is 200, because nothing changed in the production. If you issue 1,000 rupees, the product price is 1,000 rupees now. So 10 times increase you brought into inflationary regime. right? So when the quantity of money grows quickly, it produces high inflation. Clear? So you can see in the figure 2.4, money growth and inflation, right? Normally what will happen is, if you issue money today, you can't immediately, you won't, immediately have that impact. So you will have some lag impact, right? So this says the inflation rate 2 years later. You issue money growth here in the x-axis, and y-axis you can see inflation rate 2 years later, right? You can see the red dots, it's a 1960 to 1980. You can see some kind of positive correlation. That means when the money grows, inflation also grows. But from 1990 to 2000, you couldn't see. These are blue dotted lines, okay, blue dots and lines. You couldn't see any correlation. So that means it's very difficult to use M2 as a useful tool for forecasting inflation or understand the inflation, because like even the M2 grows, nothing happened to the inflation, right? This is what happens now. These are the studies based on empirical data. You are going to study, okay, what will happen when the M1 changes to the inflation, M2 changes to the inflation, or M2B changes to the inflation, and putting GDP also into that and see whether is there any changes. So if there's no changes, that means M2 is not having impact on the inflation. So you have to find another tools. Is that clear? I think I understand. There may be some, gray areas. This is the heart of this study, right? So gray areas, I understand. But you think of, and you can ask me questions to clear it out, so then I can explain further if you want. Now this first lecture, I would like to give you an overall aspect. What is economic system? What is financial system? What are the components in the financial system? And then the key role of money, right? And how to measure money. Why we need to measure money? Because we should be able to forecast the inflation, right? So when you should be able to measure money, then of course you can think of correlating with your GDP or inflation, or how that works together. That's what I want to discuss in these slides. Okay, is there any question up to now? If I want to come back to this again, right here, household and firms, right? Everything depends on the money. If you have money, you can make the payments, you can make this production continuously happening, that can fix the price, right? That can lead to inflation. So here we should be able to focus what's the production, how much household can have money, and how much they are going to use on the production, and what are the ways they can, what are the ways they can use instruments, a different instrument as a means of payment. Okay, So I think the first discussion is we can finish it. And if there's no questions, we have 10 minutes. I can just start with interest rate. Is there any questions quickly? Gavin, is it okay? Raja Karuna?
All good.
Shall we move to the previous slide,
All right,
sir?
all right.
That's about the M1 and the GDP. So it says that GDP is nine times than the M1. The GDP is nearly 9 times then what is the base of that? That is, I mean, that what I feel is the goods are available in the market, but the currency is not the less.
What is the last sentence you said?
Yeah, actually, that is the comparatively, the GDP is nearly higher amount. That is 9 times above the M1, right? So the currency is I mean, there is the M1, the liquidity. So that is comparatively, the GBP is higher than the currency. That means that the GBP is available the 9 times than the currency. I mean.
Yes, exactly correct.
Yeah, that is the I mean what is the stable the environment in that scenario. I mean, that is how we should maintain this the two variables in GBP and M1. That should be the equal, or we need to keep the ratios as like this. I mean, that is the best
Okay.
the solution.
Okay. Rajakarna, now now okay. Let's here I used only M1. You assume only I'm referring currency notes and coins, nothing else, right? Okay, I have 100 rupees. I can buy 900 rupees worth of goods and services using this 100 rupees note. So GDP is 9 times of my M1, or I can call it M0 because that's a perfectly M0 currency. Now your question is, whether 9 times the optimal one, or like whether can we reduce, or can it go like maybe 15 times? I think that's the question. Is that so?
Yes, that is the GBP is available in the market 9 times above the currency. Yeah.
Yes. Now, actually,
What
that
is
is
the best solution? I mean, that we should maintain this ratio. I mean, that if the developed country that will say that this is the area where that the US government they maintain this ratio, but in that's the best ratio should maintain, or that should be the equal. I mean, GDP should be equal to the M1, or that is something like this is the ratio where that they maintain in a higher levels in the GDP than the M1.
Thing is like this. Actually, that is not only deep. Now, which one is the better ratio? That's what you are thinking, I think. Okay. So now the question is, this 9 times is not only depends on in particular on the production as well as the currency. Now, as I said, okay, we have 900 rupees worth of production, GDP. I have 100 rupees only. The question is, in your economy, in your financial system, how fast that 100 rupees circulating again and again. Now, let's say I said, okay, if that is 900 times circulating quickly, then 100 rupees is enough for me to, buy that 900 rupees worth of stuff, GDP. But if it is not going that fast in the economy or financial system, you should have 200 then, right? So 200 means, okay, this will go like 4.5 times fast. not compared to 9 times faster. One angle I'm explaining, right? It is how it's based on how your financial system works and how your money circulating, moving towards, person to person. In a developed economy, they have very advanced financial system. Now let's assume here, if you want to make the check clearing, just an example, if it is taking a 1 week, the financial system is not efficient. So then your money is not going to circulate very quickly. But if you take the US, they might have like within a second that will go hand on hand. Then they can have a minimum amount of currency compared to us, but we should have more currencies because it's not moving fast. So it's one hand, it's based on your economic system and financial system structure particularly, and how your money creations happens. Some countries, it won't happen that bigger. Now, if you invest, if you issue a 1 rupee, some countries, it may like create money 10 times. Now, if you take in this instance, like M1 may create 9 times of money. So then they can buy 9 times of GDP there. But our M1 maybe only creates 7 times. So we should have more M1 to buy all this stuff. So there's no better ratio. It's a ratio based on your financial structure or financial system, rather, where the transmission happens through that. Now, if you Central Bank of Sri Lanka issue a currency, that will go to the banks and go to the general public and come back to the bank and then again go to the general public. So it's a speed of transmission, transfers, right? So the transmission effect also will be going slowly, some financial market. But if you take developed countries, it will go very fast transmission. So there's no hard and fast rule which one is better. So it's which one is better for your country. We can't compare with US with Sri Lanka. I will let you know next time what is our ratios, right? We will be when we study the monetary policy, we can cover that as well, right? What is our size of the M1, size of M2, and our GDP, right? So we can look into that, but it differs. We can't say, okay, this is the best. Rajakarna, is that okay, or you are still having some gray area?
Sorry, yeah, it is. I got understood about this. That is depends on the circulation, how fast the circulation on the money, right?
Yes. We have two concepts under that. Actually, we will be studying that, Rajakarna. Now, one is money creation, and you might have heard money multiplier, velocity, right? So this works into these calculations. So it's and also you should think of one more additional point. The US currency is the reserve currency, right? So whenever they print, the gamut of money goes out of the country. It's not used to buy US goods and services actually. But Sri Lanka, if you take the rupees out, you can't buy anything from abroad, right? So whatever the printed money is within Sri Lanka. But if you take the US, when they print money, it goes out of the country. Everybody is having US dollars because you can buy anywhere using US dollars. So even though they say M1 is this much, and our GDP is this one, they might be having, so much of currencies, but not used for buying GDP of their goods and services. So it's country to country differs. You got my point?
Yes. Because I thought the different perception, because I heard that in 1970s, between 1978, the goods are available, but currencies are very less. But after the open economic situation in the country, so the currencies are more, but production less. That's why I thought there's a difference, because that is the good ratio to maintain in the developed countries, to maintain its higher GDP with lower M1. That's why I thought. But it's a different scenario that will be depends on the circulation and some other aspects, right? Okay.
Exactly.
What the point, sir? What the point?
Okay. I actually like you are the 70s before open economy, those stories, maybe one side of the whole aspect. Now here also, like, we used to think, okay, we reduce the money printing, so then we can reduce the inflation, right? Kind of. So it's one side of the story, but when it comes to this ratio, you can't fix like that. Okay.
Okay, thank you, sir.
No worries. So is there anything? I think we can stop here, and please look into that and make these references out of these books. Also, I think the soft copies can be downloaded from the websites. I think that's possible. And read whatever within the time constraint that you try to read this. And if there's any issues, we will discuss, right? And this all 5 subjects, and I think these 5 chapters, like most of the times I'll be discussing, right, with the practical issues. So you have a mind mapping, as I said earlier, because like bit and pieces, definitely you will forget, right? And always we'll have the confusion because it's a subject in economics, right? You can't prove it anything, just to understand the scenario. Okay, thank you so much, and see you on the next class next Sunday 1:30. Thank you.